how do you know this is a company that need to get funding?
In my opinion,
Yeah, your personal opinion.
tech companies,
Okay.
you have to have a tech component. And the reason why I say that is because if you are building a restaurant, your restaurant is 2,000 square feet. You are the business owner. You want to serve 1,000 customers a day in your restaurant. What do you need to do?
Build another location.
That's what you got to do.
Gotcha.
I was posting about the webinar this week, and
Yeah.
I was part of what I'm doing is talking to people about how to fund your business without investors.
Let's talk about that. 'Cause
Right.
I'm so glad you brought that topic, because you think about it, right? We hear people get glorified for raising tons of money, which there's nothing wrong with that. But then how about the people that cannot raise that type of money, that doesn't have that type of network?
Not even the people who cannot raise, the people who should not raise, which is the majority of people, particularly when it comes to venture capital.
I wanna hear
Folks
more.
get patted on the back for raising a whole bunch of money.
Yeah.
And it's almost like there's a direct correlation with the amount of money that you raised and the likelihood that you are to be in court
Successful.
for a felony.
Also
They say
successful.
like the Forbes 30 under 30 list is how you know who's going to be committing white collar crimes. And it's so true. Like,
Oh man.
raising money does not a business make.
Yeah, I'm glad you said that, because you hear, oh, I just raised $100 million. But how much sales did the business actually do?
Beyond sales, if you raised $100 million and people who are investing in you are expecting that you're going to multiply that money,
Yes.
you better
Yes.
build not even $1 billion business, because that's only a 10x, and they want more than that. You need to be building a $5 billion business in order for that raise of $100 million to
sense.
make any kind of sense
Ooh.
at all. And the chances are you're not going to do that. So most likely
So,
you're not going to return that capital.
all right, well, I know we're kind of going to a different topic, but I think it's super valuable right now, right? For that denial you didn't raise any capital. You basically bootstrapped the most of the thing, right?
I raised capital on a crowdfunding platform that was
Okay.
incentive based. So I didn't give away any equity.
Ah.
When I sold the company, I still owned 100% of the company.
Wow, congratulations.
Thanks.
Not people that sold can say that.
Exactly.
And then, right, so you exited, and now you're in the space where you do venture capital. What the hell is that? I mean,
What
it's
the
not
hell
like
is
it's a
that
very
even?
it's like, very people hear the name, oh, I'm VC, but nobody really explain what the hell is that? What is that business?
What the hell even is that? So, venture capital
Yeah.
is a form of private equity financing. So you have public markets.
Yeah, like the stocks.
stock market.
Yeah, yep.
Anybody can go buy a stock
Yeah.
on Robinhood or whatever platform you use. Then you have private markets. These
Okay.
are private opportunities that are offered to a smaller group of people. They're not necessarily advertised widely, public necessarily.
So like a Facebook when
You're
before
not
they
going to
became
be
Facebook.
going on to Facebook
Gotcha.
usually and seeing an opportunity to invest into a venture-backed startup. Typically, crowdfunding has changed a little bit of that because there are some equity-based crowdfunding platforms, but typically this is a private opportunity offered to a smaller set of people at an earlier stage in the business. Venture capital typically focuses on what are considered to be earlier stage businesses.
Gotcha.
You're talking about Series B and before.
Okay.
So now
what
you're
is Series B? What is Series A? What is that? Give us that quick masterclass in this.
talking about the stage of a business. So
Okay.
right now you have typically family and friends, super early. You might be
Yeah.
like idea stage.
Yeah.
Pre-seed, seed, Series A, Series B,
Gotcha.
all the way beyond. My personal opinion is that everything past the Series B is a Ponzi scheme, but we'll get to that later.
That's
But
another episode.
That's a whole other episode. But it just defines the stage of the company.
Okay.
You have some not necessarily parameters, but some general thoughts about how much money you would be raising at each stage, the progress of the company at each stage, and just expectations around level of customers, revenue, etc. So it's very common for a pre-seed company to have very little revenue and to be very early. They might be starting to gain a little bit of traction with customers, etc., but they're still very early. If you're Series B, you better have some pretty significant revenue and some, like, not even signs of product market fit. You found product market fit, you're scaling, you're going into growth stage. Like, what you're doing now is growing.
Okay, so I'm gonna put it in my lame's turn as, a business owner that's trying to figure this out, right? So I started a business. I have this idea, but I know I need money. I go to friends and family. That's pre-seed.
That's correct? Friends and family. That might be even before pre-seed.
Gotcha.
There are some instances where people are going straight into pre-seed funding, though.
Gotcha. So now, with that money, I may put it in the business. Maybe I got it to 100,000. At that point, I'm like, okay, maybe I need to get some more money. So that's when I go to like a pre-seed.
A seed.
And seed is who exactly? Private people that I know that maybe have money, like angel investors.
It can be any of those.
Gotcha.
So it really depends on your network and who you can find to invest. So you might raise enough seed capital from grants, government funding, family and friends, or angels to not ever go to venture capital funding. And then even beyond that, there's so many investors or types of investors that venture capital is still relatively niche. Like, these are terms that we're using in the venture capital space to outline companies, but most companies are not going to get venture capital funding, and they shouldn't. They're not really built for that.
What's built for that? Like, how do you know this is a company that need to get funding?
In my opinion.
Yeah, your personal opinion.
In my opinion, tech companies. You have to have a tech component. And the reason why I say that is because if you are building a restaurant, right? Let's say you've got a restaurant right here. We're on Lowry. You got a restaurant on Lowry. And your restaurant is 2,000 square feet. How many customers can you have at one time in a 2,000 square foot
Let's say about 30 to 50.
30 to 50. So how many people do you think you can serve each day if you're open all day in that restaurant?
Roughly, let's say maybe a couple hundreds.
Okay. So 200 customers a day. You are the business owner. You want to serve 1,000 customers a day in your restaurant. What do you need to do?
Build another location.
That's what you got to do.
Gotcha.
You can't serve.
You can only go as far as
in a restaurant that only holds 200.
That's good.
So you've got to build another location. You've got to hire more people to work at that location. You've got to put the equipment in that location. You've got to run that location. You got to get the food. And you've got to get all the things that you need, the tables, chairs,
same system, everything. Boom.
You've got to get that. And every time that you want to expand, you've got to make that restaurant bigger, or you got to get another restaurant and you've got to hire more people and do that thing over and over. If you are, what tech company can I talk about? Because I usually talk about Spotify, but I'm tired of giving Spotify to shine. Okay. Let's say you are Klarna. Have you ever used Klarna?
Of course.
To do the digital version of layaway.
Yeah.
Every time I look at it, I do it just because I'm like, oh, why would I want to pay now when I could pay later? But it reminds me of when we used to go to TJ Maxx when I was little.
Put things on layaway.
Put up things on layaway. Mom be like, okay, I'm going to put this on. I'm going to come back and okay, with the plan. And I'm like, oh man, we are doing the same thing now except digitally. And we think it's so fancy.
I know, or it's brand new.
$1 billion company. I'm like, my mama was doing this at the Marshalls when I was a child. But anywho, if you are Klarna, you have a technology that allows people to pay in installments when they're paying for things online. If you want to serve Today, let's say today you have 500,000 customers and tomorrow you want to double. You want to serve another 500,000 customers. Literally tomorrow, what do you need?
More money, expand the software that I'm using, expand the backend that I'm using. That's where virtual capital.
So
Gotcha.
Backend, you know, you already have the infrastructure to do what you're doing. So maybe you need to have some more cloud storage and you need to be tapped into more restaurants. Maybe more developers.
Yeah, with AI, maybe an AI tool to add to it. So there we go.
Maybe you have to hire a couple more developers. Maybe.
Yeah.
Maybe you need some more cloud storage so that your system doesn't break because you have that many more customers
on the platform. Yeah.
But in general, what you have to do as a software company in order to serve a big bump in customers tomorrow versus what a restaurant has to do are very different.
Yeah.
Because your growth is not as dependent on all of these finite physical resources as the restaurants.
Gotcha.
Their growth is limited by labor, space, equipment, supply chain. If you're Klarna, you don't even really have a supply chain like that for real that you need to be worried about. You just got to make sure the system doesn't break. It can handle the extra load. You can plug into more websites and do this whole Afterpay thing for more people tomorrow.
Yeah.
And the cost of doing that and the resources required as well as the input required is much more marginal than it is for a restaurant.
I see.
So because of that, a restaurant can't grow exponentially. No one's going to invest venture capital into a restaurant.
Yeah.
Because if they're like, I want this investment to multiply by 100 within a short time span, in order for a restaurant business to do that, it would probably have to do some highly unethical things in order to make that happen. Klarna, you know, your investment can grow by 100x in 5 years.
Gotcha.
Because they had a few more developers who are in there jamming. They get some more cloud space. Boom. They can serve unlimited customers, theoretically.
So it's the hyper growth.
The hyper growth in the period of time, in a short period of time.
Very short period of time.
And we're talking a few years, is what really drives venture capital, coupled with the fact that these are typically businesses that can't get other forms of capital that are tied to assets because they're very asset light. If you're Klarna, you might have a code base.
Yeah, so it's the IP.
Nobody's going to go give you a loan and be like,
on the IP.
If you default on this loan, I'm going to repossess your coding.
Gotcha. Yeah, what? It's not real estate that you can take. Yeah.
So that means a restaurant can get a loan because they got equipment in there that somebody can come take. They got real estate somebody can come take if they don't pay back the loan.
But
so it's very risky.
Gotcha.
It's considered to be much more risky. Not to say that restaurant business isn't risky, because it is.
Of course.
But it's considered to be very risky. Most startups fail. And you are in a very early stage of the business where it can grow, and still fail.
Yeah.
But it might grow. You might hit. And if you hit, you're going to hit in a way that you are not going to do with a restaurant or a consulting company or company, in my personal opinion, even a product-based company. Like, unless you're liquid death, you're not going to sell enough water to grow at a venture-backed pace.
Gotcha.
So I told some founders yesterday, I'm a entrepreneur in residence for Black Ambition.
Okay.
And I told some founders yesterday with Black Ambition, like, my personal opinion, product-based companies should not be taking venture capital. You are 99.9% likely to not be able to keep up with that pace and return that capital.